Hello, everyone.
Hi,
Hope you're having a great day. This is Phil Jacob.
Melanie Jacob from Philip Jacob and Associates.
We wanted to give you a quick market update based on some articles we've been reading.
Yeah, Phil, you're a voracious reader. He's constantly scouring the headlines on all the top things. And this week, the constant theme came through was about the market.
Yeah.
So what have you learned?
Well, first thing I want to share is an article from in the Business Insider, as you can see here. It's published on November 4th, but from Morgan Stanley. And Morgan Stanley was looking at a traditional 60-40 split portfolio. And what that means is as people start off working, usually financial planners will advise you to be 100% in stocks, in equities. And then as you grow older and as you're banking more wealth, they advise you to start shifting to first 90% stocks, 10% bonds, to eventually to get to a 60-40 split, like 60% equities, 40% bonds.
So is that like the longer you have to invest, the more risk you could take? So you have more risky investments.
Right. The thought is that if you're investing in bonds, loans that Fortune 500 type companies, blue chip companies are making, then you'll be okay. They'll still be paying you interest on those bonds that you've purchased over time. So you're still getting some income and you're not taking a big hit as equities go down, and then,
Right.
But
so now that for people who are, getting a little bit older, maybe they're 50, they're thinking about retirement in the next 10 years, what kinds of things are you thinking? What should we be concerned about?
So according to Morgan Stanley, what they're saying is the returns for a 60-40 split portfolio should drop from what it is roughly today over the next decade to only about 2.8%.
So that's about today.
That's about half. Today should be at almost 6%. 5.6% is what they're saying if it's 50%.
Okay.
So
people are typically happy with 6% returns in the stock market.
I think they'll be happier with 6% versus 2.8%.
Okay.
Because ultimately, as you get closer to retirement, and you're using money to live on, you don't want to really tap into that nest egg. You want it to be constantly generating wealth, and preferably generating more wealth than you need.
Right.
So that's what we have to be really concerned with. You can see right here, this is where they make the comment about 2.8%. And their assumptions is that the S&P 500, which is usually one of the big indexes that people look at, will continue to gain about 4.9%. And the treasuries, the US treasuries, will yield about 2.1% over the next 10 years.
Okay.
And given how low interest rates are now, that's probably good assumptions.
Okay. What did New York Times have to say?
The New York Times, as you can see, did an article on the housing market needs more than low mortgage rates.
So aren't the low mortgage rates, the lowest they've been in so long, isn't that enough for people to help them find a house and get a loan for a house?
Well, it turns out, according to this article, that with Dodd-Frank, because what happened was we had the meltdown in 2008, and with Dodd-Frank, a lot of criteria were tightened up to help prevent there from being the abuses that were in the system prior to 2008.
So before 2008, banks were very generous with loans, right? Very generous to give out. So you want to buy a house, okay, you don't need to put much down, or here's a loan, okay, you can qualify for a bigger house. Right. So they were really generous before 2008, and that was part of the problem.
Right, and as you can see it based on the housing credit availability chart here in the New York Times, credit was relatively very free based on that index. but now it's dropped to about 5.6%. And it's been roughly in that range since about 2012. And so what that means is even though you may have funds, and even though you may be working a normal, a job, if you're a private business owner, et cetera, it could be that you may not be able to get a mortgage very easily from a traditional bank.
Right, because banks are looking at FICO scores, and they're also looking at debt to income ratios. So for people who don't actually have W-2 income, they may have more challenges. Even if they have a good credit score, they may have bigger challenges.
Right. And then here's the other reason that you'll find. One of the other big reasons that the New York Times is highlighting that there is potentially a big issue is that if you look at wage growth versus home prices, you can see here, based on this, and the home prices are from the Case-Shiller CoreLogic S&P the 20 City Index. It's actually one of the core indexes that's used for a lot of economic analysis when you're looking at real estate.
Okay.
Anyway, as you can see, wage growth has been pretty good over the last 7 to 8 years. It's roughly 20%. But
housing
prices have just shot up to almost 60%. 60%.
There's like a 40% difference.
Yeah.
So how can someone whose income who's gone up over the last 7 years not match the housing price match?
Yeah.
And how can they, and if they don't actually have a good income, how might they afford a house?
Well, I think that what happens then is that people will move from these higher cost areas.
Right. Like California, Boston, Seattle,
down to lower cost, where the home prices and the wages are much closer to what they can afford. But I think beyond just the financial look, you should also consider, well, where would people really want to move? We're seeing a lot of like millennials here in Detroit want to move into downtown Detroit,
right,
to living in those multi-story buildings, being in an actual downtown and stuff like that. So
what are the median home prices in the area?
Right now in the Detroit metro area, we're looking at about 163,000. While homes
that are pretty consistent throughout the Midwest, whether it be Ohio or Indiana or Michigan
or Illinois. It's all roughly similar. Now, you could say, well, what about Texas and places like that? Yeah, there are a lot of people moving from these high-cost areas into places like Arizona, Texas, Georgia, kind of the bottom of the smile states. But you also have people moving to the Midwest. But as people are moving to places like Texas specifically, you're seeing the home prices radically increase. And what that means is if you're there already and you're moving in from a high cost state, then that's great for you. But if you were already in Texas, your income may not be holding up to the increase in housing. And you may see another wave of people move out of places like that, in places from Houston, Dallas, Austin, places like that, to less expensive houses.
So thanks, Phil, for this market update. This is Phil and Melanie Jacob with jacobassociates.com. We hope you like listening today. There'll be some links to these articles below. As well, feel free to reach out to us or connect on social media, whether it be Philip Jacob and Associates on Facebook, Twitter, or Instagram. Great to talk to everybody today.
Thank you. Have an awesome day. Bye.